Well, good evening, everybody. It's Blair Nightingale here coming at you from the West Coast. Market Monday, our friends out across the country. This is where we join every Monday night. We got something different for you every single week, but we're always looking at the market. My goal to give you something that you can use. I've been saying it a lot lately. The goal of a trader, which is what we do here at Tradeway, we teach people, even people who don't know anything whatsoever about the stock market. Okay. You could know zero about the stock market. You can know a lot about the stock market. We work with people in both of those categories all the time here at Tradeway. Come on here every Monday night because I want to help you guys get something that can help you fulfill the goal of a trader and perform the role of the trader. What's the goal of the trader? The goal of the trader is profit. We don't mix words. That's the goal of the trader. It's to make a profit in the stock market. Did you know you can just use a few simple tools on your computer, even on your phone? You can start trading actively in the stock market. The goal is profit, but the role of the trader is to understand how to manage risk with your money. Yes, you have to take some risk if you're going to be a stock trader, but we don't guess, gamble, or go for it. That's not what we do. That's not how we trade. That may be how other people trade, but that's not how we do it here. And Market Monday is about us getting some time together every single Monday night so I can share a piece of that role with you and hopefully help you get closer to that goal. That is why we exist. Tonight, we're going to dive into some companies that you've no doubt heard of. You've probably even used those companies in the last, say, 2 hours, maybe the last week. We're going to talk about that tonight, looking at Google and Amazon, two huge companies that are traded in the stock market. But they've got some very specific things coming up this summer, right? A couple of really important events. We actually haven't seen this happen in Amazon stock since 1990 already. You can tell I'm going way back. 1999, before the dot-com bubble burst and the stock market crashed in the year 2000. They are doing a stock split. If you follow stocks at all, you may have heard this in the news. If you follow stocks and you haven't heard this, you're going to want to hear it. And if you've never invested or traded in the stock market before, but you're interested in, you know what, I'd like to do some investing. I would like to know what are some things I could pay attention to in the next 3-4 months that might be a good opportunity. I'm going to talk through that today. All right. I'm going to talk through that today. This is a stock split. I'm going to teach you what that even means for those of you that don't know. But let me just say this right off the bat here, because I want to cut to the quick on it and tell you why should you even care? Why would anybody care? Because Amazon currently, for example, is trading at $2,921 a share, almost $3,000 a share. It's dropped some in the last 3-4 trading sessions. Okay, it was well over $3,000 a share. But what's going to happen is it's going to be significantly, I would say, discounted. That's maybe one of the misunderstandings about a stock split. What you need to know is that the price of Amazon for one share right now is about $3,000, but it's going to be about $150. You say, wait a second. If I want to own a piece of Amazon, it's going to cost me $3,000 just for one share. That is correct. But at some point in the near future, you can own one share of Amazon for $150. Now, I got to tell you the details, but that's what I want you to understand from the outset tonight, because this is something that stocks do from time to time. They do a stock split. When stocks appreciate, companies that were small, say Amazon in the 90s. I remember using Google, which is the second stock we're going to talk about. I remember using Google in the days of dial-up, right? We're talking the mid-90s. Those dial-up modems, so slow, so loud, took up your phone line. They had Google even back then. And Google, here we are, some 25 plus, almost 30 years later. Google's still around. So what has happened to the stock price? Well, it used to be low And then when a stock grows, obviously that price appreciates and appreciates and appreciates and appreciates. And after enough time, 2 decades plus of time, the shares of that company have appreciated, in this case, Amazon and Google, they have appreciated so significantly that it becomes a major barrier for entry for a lot of people, right? Now we're talking tonight trading and investing. Normally here on Market Monday, we fixate on the skill set that is for investing. I will talk trading tonight, but we normally talk trading, but I do want to get into a little bit of the investing mindset, because when it comes to these companies, we're talking more in the stock split about, is this something that I could be potentially interested in buying and holding for a longer term investment? Okay. When these companies appreciate as much as they have, when they've grown, look at Amazon. I mean, Amazon was a little .com company that sold books, right? Now it's one of the biggest companies in the world. When's the last time you guys used Amazon? I know there are a few people out there, they don't use Amazon, but most everybody uses Amazon all the time. It has such a foothold on e-commerce. Its logistical network alone is just unbeatable, right? It's unbeatable. You can order something, and in some cases, depending on where you live, you'll have it by the end of the day, right? That's crazy. Well, Amazon has really brought that into the forefront, and they're the leader. They may not be the leader forever, but right now, as far as what they do, they are the leader. And that means that price of those shares has appreciated significantly to where you and I, if we want to trade Amazon, if we want to buy and hold Amazon, to hold 10 shares of a $3,000 stock, that's $30,000, right? To buy 10 shares. So what are some potential things that might happen if that's the case? Well, you might not get as much buying interest, certainly from you and me, the retail investing crowd, right? Retail investors is what Wall Street calls you and I, right? We're not the big banks. We're not the investment banks, the hedge funds, right? That's not us. So we might not be so apt to invest in those companies. Now, we've talked about options a lot on Market Monday in the last little while. Options can be something where we can spend significantly less than that $3,000 and still buy Amazon, potentially profit when it goes up. We can even buy put options, profit when it goes down, and do some even other cooler stuff than just that. Using options is dynamic. If you haven't seen those episodes that we've been doing on options lately, you can always go back on YouTube and watch the library of previous episodes there. But without that, you're buying them at $3,000. Now, I mentioned Amazon about $2,921. $2,465 is the price for Google at this present, the closing price today. So you're still looking at paying a lot more money for a single share of stock, right? Now, stock splits, okay, stock splits are very interesting, all right? Now, I want you to picture something with me. If we think of a company as just one big circle, right? You got a pizza, right? That's the whole company. That's the ownership of the entire company. Now, let's say we cut that pizza, okay, into, let's say, 50 million pieces. Now, those are going to be some really small pieces, but this is a pretty big pizza, right? You cut it into 50 million pieces, and each one of those pieces represents a tiny little bit of ownership in that company. In this case, let's say Amazon, right? You may have heard in Twitter the last few weeks, Mr. Elon Musk is looking to buy the entire company. Well, he started out by buying 9% of Twitter and becoming the largest single shareholder. In other words, there's a big pizza with many millions of pieces, and Mr. Musk went out and said, all right, how much do I have to buy to own the majority, right? Nobody else owns more pieces than me. Now, the other owners combined had more than Musk at about 9.2%, but nobody else had single ownership higher than him, which meant that he had a majority stake in the company. That gives him a lot of power and influence in that company, because shares of stock actually give you the right to vote on issues, decisions, directions within the company. Okay. Now, not on everything, but there are times when shareholders have that voice. Of course, you also buy the shares, and if the company appreciates, you could stand to appreciate in your investment in those shares. So we've got that big old pizza, right? But each piece can cost $3,000. Now, let's say there are 10 million pieces there, okay? The value of that company, in essence, is going to be divided up into all of those shares. And relatively, that's going to give us the value of those shares, right? The market value can actually fluctuate somewhat above and somewhat below those shares, depending on speculation of what they feel like the company's going to do in the future. I just mentioned Elon Musk. At one point last year, if you took the value of the company Tesla and you just divided what we call the book value of the company, you divided it by the number of outstanding shares, okay, then you would get a particular value on those shares. That's how a lot of people think that open market shares are priced, right? Just the value of the company divided by the outstanding shares, right? By the way, when I trade in the stock market, I don't really need to do any of this. I want to teach you guys about stock splits tonight, and we need to lay a little bit of foundation to understand how it works. But just so you know, when I started trading, I didn't know ratios. I didn't know who Elon Musk was. I didn't know what outstanding shares meant. I had no idea. Most of you, I'm willing to bet, have more knowledge about the stock market than I had when I started. And I like to reinforce that because I want you to know that you don't have to know all this stuff to be a trader. That is not how we do it. But again, we're looking a little bit more at the long-term investing mindset. Those are two different mindsets. I tell our students, listen, if you're going to enter into a long-term relationship with somebody, you're going to want to know the internals, right? What's going on in that person, right? I'm not talking about being unkind, but I am saying we ought to know what's going on in them. How healthy are they, right? If two companies are going to come into a long-term agreement, they ought to know how healthy is the other company. This is a long-term partnership. What I do is going to affect them. What they do is going to affect me. That's a little bit different when it comes to long-term than trading, which is very short-term, right? That stuff doesn't matter as much because when we trade, we're in and out of the position. We're in and out of Amazon, Google, Tesla, whatever it is, in a matter of days and at most weeks, right? We're not in very long. So when we buy and hold, invest, it's longer term. I need to know, how healthy is this? Some of these ratios and pieces of information that I'm telling you are ways that Wall Street looks at the company and says, how healthy? It's like going to your doctor and getting a checkup, right? We want to do a financial checkup on the companies that we're going to do a long-term buy and hold with, right? We want to do a checkup and go, okay, looks good on the outside, but let's find out how healthy it is on the inside, right? Now, when I was talking about Tesla, if you took the pizza that was Tesla last year and you divided it by all the outstanding shares, right? If it was just the value of the company that we divided up, okay, you would get one particular price. That's what we call the essentially the price to book ratio, book to price ratio. Book value of the company divided by the shares gives you the price of each of the shares. But the market is a free market. You and I can go out to the stock market and speculate. We can pay more for them if we want. We can pay less. The market can drive that, right? If people think Tesla is going to be worth more than the company is worth now, next year, they might be willing to pay a premium, which means that if this is what the book value of the share should be, it might be trading all the way up here. Now, there's risk to that because it could come back down, right? But if there's a lot of positivity around a company like there was around Tesla when it did a stock split, right? Then it can trade way above its book value. In fact, at one point last year, Tesla was trading at 111 times the book value. 111 times the book value. Now that's bonkers. Let's go back. Let me just do this real quick. He said, did he just say bonkers? Yes, he did. He did. Okay. Let me zoom out on here. You know, where are we right here? That's January 2020. Okay. The stock price on that particular day, January 13th, 2020, is $91. Okay. Now we're going to go up to here. January 21, $900. In 1 year, Tesla went up by 9 times. Do you think Tesla itself as a company grew by 9 times? Did Tesla's sales, amount of cars they shipped, infrastructure, right, revenue, did it increase 9 times? No. No, it didn't. But the speculation on these shares did. In fact, you can see now a little pullback into this area. And then what happened? Oh my goodness. Right? November 16th, where was I right here? January 21, November 21, not even another year later, right? Not even, almost 10 months, not quite. Now it's up to almost 1,300, 1,200, just over 1,250, right? In 2 years, it almost went 13x. So the shares traded at a higher level. But look at this little S down here, guys. Right here. What does that say in the little box there? 5-for-1 split on August 31st, 2020. It's funny. You know, I thought last couple of years been a blur. I thought that was actually even sooner than it was. And what happened was Tesla split, meaning that pizza, okay, let's just make it really simple. Let's say that pizza was only sliced into 10 pieces. Now, those are big pieces. That's Tesla busted up into 10. It's actually busted up into millions and millions and millions of shares. But for you and me, to make it nice and easy right now, let's just say Tesla was in 10 pieces, okay, 10 pieces. And each one of those shares cost $100, okay? Tesla, 10 pieces, $100. Okay. They did a 5-for-1 split. So let's say I owned 1 share and you owned 1 share. We each own 1 share at $100. Our value is $100. We own 1 share. And then Tesla says, all right, we're doing a 5-for-1 split on the stock. What does this mean for me and you as an owner? And maybe some other friends out there who were thinking about being owners, but you're not an owner yet. Okay. What does this mean? It means that my 1 share at $100, okay, I'm after the split date, in this case, August 31st, 2020. Okay. My 1 share is going to become 5 shares. 5-for-1 means that they will give me 5 new shares for every 1 share that I owned prior to the split date. You say, well, wait a second. If the shares are worth $100, right? I had 1 at $100. You had 1 at $100. And they're going to give me 5. And doesn't that mean that I'm now going to own $500 worth of Amazon? Or gosh, I keep doing that. It's so funny tonight. Tesla, we're going to get to Amazon. We'll get there. Does that mean I'm going to own $500 worth of Tesla stock? No. It's actually not. I'll own 5 shares instead of the 1 I owned, but each of my shares will now be worth 1/5, in this case, $20. Okay, hold on, Blair. Wait a second. So I owned 1 share at $100, and then Tesla said, hey, we're going to do a split 5-for-1. So give us your 1, we'll give you 5, call it even. And that's exactly what it ends up being, even. I had 1 share that cost 100, was worth 100, and now I have 5, and each are worth 20. 5 times 20 is 100. So now I own more shares, but it's the same value. Is that correct? Yes, that's correct. That's how a 5-for-1 split works. It could be a 10-for-1. It could be a 2-for-1. It could be a 20-for-1, right? You give them 1, they give you 20, 10, 5, whatever it is. In this case, on Tesla, it's 5-for-1. You can see that on the bottom left of the chart there, 5, 4, 1. But it equals out the value. So then my shares actually end up being the same amount of value at the split point. Okay. Now, there could be speculation. What if the shares, by the way, this chart adjusts for the split. Okay. So it's automatically adjusted for the split. We don't see two different price ranges pre and post split here on the chart. Our software does that for us. So it looks like one price flowing the whole time. But really, our $100 share became 5 $20 shares. But if the stock returns to its split price, which was what? $100, right? If Tesla still grows and a lot more other investors go, wait a second now, Tesla is only $20 for me to buy a share. I still have a lot of confidence about the future of Tesla. I would like to buy some of that. And maybe at $100, I couldn't do it, but I'm going to go out and buy a few at 20, right? It may spark more investment interest, okay? Because they anticipate growth, right? They anticipate growth. There's going to be more shares in the market. It's going to lower the value of the shares, but it's also a lower barrier to entry. And there's a confidence that there's going to be growth in the future, and they lower that stock price. So you and I could see it return to the the pre-split price is what we would call it, which if it was $100, we owned one share at 100, right? And if it gets back to 100, now we own 5 shares at 100. Warren Buffett, many of you have probably heard of Warren Buffett. If you go and look at Coca-Cola for a long time, most of Warren Buffett's money was made by him. I think it's after his 50s. It's after his 50s. It wasn't early in life. It was later. There's a great quote of his that basically just says, if you want to be a great investor and make money in the stock market, you ought to start early or live to be really old, right? Now, what he did, I'm going to go to a much longer time frame here. I'm going to go to a 10-year. Let's go to a weekly here. I can't do the weekly. I'm going to have to do the daily. 10-year daily. All right. Maybe we try there, it finally switched. My internet's just a little slow. Yeah, you can see there's one right here. There's a split back here. It's not showing it because there we go. We'd have to go further back. So it's not showing on the chart unless I go way back. Warren Buffett owned Coca-Cola a long time. He only owned one stock for a very long time. He owned one stock. Now he owns all kinds of stuff. But he owned one stock. It was Coca-Cola. And you know what Coca-Cola kept doing? Kept splitting. And it would split, and he would get the same value initially, but more shares. More shares is more leverage. Then it would return to its pre-split price. And instead of, like our example, the Tesla, that was 100, and we only owned one, then he had 5 that returned to 100 again. And now you have 5 at 100 is 500, right? Buying and holding. Well, Blair, couldn't Tesla have just increased by 5-fold with my one share? Yes. Yes, it could have. One share of Tesla could have just gone up to $500, right? That would have worked too. Then your one share would have been $500 instead of your 5 shares. But again, there is speculation over the confidence that investors have or companies communicate to investors when they're splitting the stock. And again, it's also bringing that lower barrier to entry. So when we go to Google, we look at something that is, once it switches over here, zoom in a little bit. Look at that, $2,500 a share. Now this has been just screaming hot, right? $2,500 a share. You think maybe we might bring in some new investors or some more confident investors? Confidence, if there is a split, right? Lowering that price. Now, there are many different reasons why a company might split. We won't go into all the technical details tonight. But we need to know that these are happening. You're going to see it in the news. You're going to hear about it more. You might see some pretty wild price action around them. I'm going to give you the dates for them. You might see some pretty wild price action around Google and Amazon this summer as it gets closer to the split, because people will speculate, should I buy it before? Should I buy it right after? I'm going to give you a couple of thoughts to consider that I think will make it easier for you to answer that question for yourself. First thing, though, it was March 9th, Amazon announced we're going to do a stock split, which was pretty big news considering, like I said, it hasn't happened since 1999. They are going to do a 20-for-1 split. 20 shares. So if you own one, they'll give you 20 at 1/20th the value. So it'll work out in the wash. But again, if investors are speculating that Amazon will come even close to this value that it's currently at right now, remember, it took some time for Amazon to get there. But if people get pretty excited that Amazon is that cheap in one sense, we could see some price appreciation. That's the speculation for buy and hold investors around the stock split. By the way, Tradeway actually teaches an entire course on stock splits, how to trade them and use that, not so much buy and hold long term, right? But actually, how do I trade a stock split? That's something we teach in our program. If you haven't even started, thought about it, looked at it, go over to tradeway.com right there on the main page. You can do our Step 1 Start Your Journey course, right? It's literally called Step 1 Start Your Journey because that's where you can start your journey. From there, we show you the whole Tradeway program. Stock splits is actually a part of that. 20-for-1 stock split on Amazon, 20-for-1 stock split on Google as well. That means $146 respectively, right? That's if they split today. They may not split today, or they won't split today. It may not be that price when it splits on June 3rd. That's Amazon. July 1st is Google. Okay. So whatever that closing price is, it will be a 20-for-1. You just divide that price by $20 and that'll be that split price. If you own the shares before close that day, the next day, your account will show the adjustment of share ownership based on that 20-for-1 split, right? You'll keep the one share you have, the value will change, and they'll give you an additional 19 shares, right? Depending on how many you own, of course, you might have more than that, right? So the question is, what kind of an opportunity is this for me? Should I be thinking about buying some? Well, here's what I'm going to say to keep it absolutely as simple as possible. While there are aspects of this that may be attractive for investors, ask yourself first, would I want to own Google and Amazon long term? Remember, that is what I'm focusing on more tonight. Again, we teach in our programs how to trade. Remember that short-term versus long-term commitment? Trading is a short-term commitment, okay? It's not a long-term relationship. We're teaching in our program how to do stock splits. Now, on the other side of the equation, it's the long-term. In that case, I would ask you, do you want to be an owner for the long-term, which is the ups and downs of owning Amazon, of owning Google at this point? I'm not recommending anybody jump right out and say, you know what, I don't really want to own any Amazon or Google right now, but they're splitting, and I guess that means I ought to go and buy some. Because what I want you to know is that even though it's going to split, and these are great companies, the first thing I would say that even if it splits, well, it is going to split, but even when it splits, the stock can still go down. This is not a magic pill. It doesn't mean that the stock is just going to immediately zoom up. Now, it may have an explosive short-term price appreciation. I don't know that yet, right? But it doesn't have to just because it's splitting. Now, Tesla, in the example we gave earlier, did have a bit of a sell-off, and then it got a pretty strong bump. But I would also note that at that point in time, summer 2020, the market was experiencing some pretty stellar appreciation based on very low interest rates from the federal bank and a lot of stimulus money as we came out of the initial lockdowns in COVID, depending on where you live in the country, of course, but the market obviously coming out of that major drop that we saw in March and April, and some pretty wild recovery happening into the summer. Tesla certainly benefited from that. Tech stocks, Amazon, Google, in a bit of a tough spot right now. We're starting to see interest rates rise. We're starting to get some forecasts, potentially looking at a looming recession. If I was going to go out and buy tech out a stock split on the table, I might say, I got to know if I really want to be investing in tech right now. And I don't necessarily just want to ignore that because there's a stock split on the table. That said, if you're saying, you know what, I wouldn't mind putting a little bit of money into an Amazon or a Google, I just haven't been willing to put that much in. And now I could potentially be a long-term owner with significantly significantly less skin in the game, because maybe I'm just going to put less money in than I would have otherwise had to when I bought one share. Now, that would assume that you purchase post-split, because remember, you're not going to get that split price unless you wait till after the split dates that I mentioned. If you bought it before then you might be saying, hey, I'm looking to enter a long-term relationship where it gives me more ownership and I want to benefit from the appreciation that I might think is likely to happen as a result of the split. And historically speaking, it depends on what stocks we're looking at. But companies like this that are pretty strong companies, flagship companies for sure. Google is very large. Amazon, obviously, I mentioned already. They're both household names. I'll tell you that, right? Let's not miss the forest for the trees. These companies aren't going anywhere tomorrow. I would say with some headwinds in the tech industry, we might see a bumpy ride. But for those that are interested in getting ahead of that and saying, you know what, I'm willing to take some risk. I'd like to have some ownership. The stock split is just one more thing that makes it a little bit more interesting and a little bit more attractive to me as a long-term investor. I would say this could be a great opportunity for you. Just remember, it's just not a magic button just because it's splitting. And it's easy to say that you could buy Amazon or Google on a discount. But as I mentioned in the breakdown of what a split really is, it's not actually at a discount, is it? Because initially, once it splits, it's the same value. You're still paying the same amount of money for the same amount of ownership after the split as you would have directly before it. Now, you own more shares, and that could potentially give you more leverage, which is why I say that for some investors, that's just a little bit more icing on the cake. If they've been considering it anyway, they might say, you know what, I'm getting in this thing. But I don't want you to miss a little bit of the concerns I have when I look at the tech industry as a whole. Now, I will say this too, and this is one thing that has changed a little bit about buying splits. Because let me just check here. I haven't looked in a second. Let me take this off of here. I want to make sure. Yeah, great question. I was just going to say, I want to make sure about, there's no questions in there. So Adam's asking, can you touch on what happens with options during splits? And that's a phenomenal question, because I think that's pretty important. But one point I wanted to make first is I love that question. I lost my train of thought here. Oh, that's right. Recently, okay, I started in 2015. Okay, so it's a little while now, right? You know, it's not brand new. We're talking 7 years, but still not that long, right? In a short amount of time, brokers have changed the industry significantly. I'm just pulling up something here. You guys should be able to see this. Okay. Sorry, guys. Had a technical issue there. You can buy fractional shares in brokerage accounts now. You couldn't do that just a short time ago. Now, there's lots of other things. You used to pay more money for trades. Now stock trades are free, all kinds of stuff like that. But you definitely didn't have the ability to go out and buy fractional shares. Now, how's that relevant? Well, fractional shares mean that I could potentially go out and buy Amazon, and I actually own a fraction of a share. I don't need to spend, $2,921.48 as of today's closing price. I could go out and spend $100 and own a small percentage of a share. What I'm talking about in the split is similar to that in the sense that I might be able to invest for a lower amount of money, but it's not apples to apples because I actually am going to own an entire share, or of course, in the case of actually being in Amazon pre-split, I'm going to own 20 shares, right? I'll end up owning 20 shares. So that's something that I know people have a question about in these stocks. Okay. So let me pop this up on the screen here for a second. Yeah. What would happen to options? What would you touch on? What happens to options during splits? Okay. So there is an adjustment. Okay. I personally have not, I have to think about this now for a second. No, I have personally never been in a stock option during a split. I've been in a stock when there was a reverse split, and I meant to touch on that. So let me hit that really quick as I answer your question here. You can actually do, as I showed you on the chart, right? Tesla was a 5-for-1. I own one, they give me 5. Well, you could actually do a reverse split. A company announce a reverse split. They're not actually going to lower the stock price. They're going to increase the price, right? I had a conversation with a student about a week ago about this, increasing the price so that this particular company could be listed on the NASDAQ. You need to have at least $1 listing price for a certain amount of time to be listed on one of those major exchanges. You can't be a penny stock on there. And if you go into the penny area, then you have to get back above $1 sooner than later. They have a specific time frame on that, or they will delist you from the exchange, right? One of these companies a few years back was HMNY. Some of you might remember the ill-fated movie pass. If anybody out there knows what I'm talking about, put it in the comments. It was a very fascinating story, but I digress. The stock price may be, let's say you own 20 shares, right? And instead of them increasing the amount of shares I own, instead of a 20-for-1, they might do a 1-for-20. So I owned 20 shares and now I only own 1. But it just works the other way around. That 1 share is now going to be 20 times the value. And it raises the stock price. Typically, this is not a good sign for a stock. Okay. Typically, that's not a great sign. We want to see the other things. There's a reason we're not seeing some of these really great companies doing that. I can't say authoritatively whether or not great companies never do that. I haven't personally seen it, but that's the reverse split. Okay. So when we get into options here, when we get into options, I'm just looking at something here quickly. Yeah. Great resource for you guys out there. If you have a question, and this, I tell our students on our live webinars all the time, I've learned a tremendous amount. If there's something that I can help you with, I'm going to answer it. If there's something I don't know, you know what I do? Well, first of all, we have amazing coaches at Tradeway who've been doing this even longer than I have, right? But also, I've learned a tremendous amount from my mentors, but also something quick you can go out, you can look at. You know what is a great website that has a ton of specifically some trading stuff too, but some long-term buy and hold investing, like I said, about the stock split or some different things like that. It's a site like Investopedia, for example. You know, it's a very useful website. But what's really going to happen here is it's going to simply adjust the value in your option for what stock is doing. Now, I want to say this, and this is something you won't go and read. The volatility around the option, okay, like an earnings date. Now, I'm not saying this is exactly the same as an earnings, report. Okay. Because by the way, we don't stay in stocks or options when there's an earnings date. There are several reasons, but one of them is that the price fluctuation, the volatility is just far too high. You're going to notice that the value of that option, if you're going to buy it especially, is going to get significantly higher because the expectation of volatility is going to rise. Market makers will charge you and me extra money when they expect volatility. Okay, so they're going to actually charge more money on the purchase of that option. And get this, that means it's like a balloon, right? The price of that option is going to inflate as we get nearer to that volatility. So you and I go out and we buy an option, and let's say we pay $350 the day before the split. And then the next day, even if the stock moves up, guess what might happen to that price? The balloon contracts. Why? The stock price went up. Shouldn't it get even bigger? Well, it will a little because it should move up with the appreciation of the price. That's how call options work. But if most of what you paid was for the volatility, I know I'm tapping into a new concept here for you options traders, but if you paid a lot because of the expected volatility, and then after the volatile event, what do? They suck that premium out of the price of the option. And you'll find sometimes the stock actually went my direction. And I might be breaking even or worse, depending on how bad that balloon gets emptied afterwards. That's something, side note, that I want to throw in, because as we get to those events, we have to understand how options work. So if we're going to take advantage of some of that volatility, we understand how to do it in the proper way. You might want to think about actually some different strategies that sell the option versus buy the option. Now, there's lots of things to discuss in relation to that, but it will definitely be something that we need to go into another time. So essentially, what's going to happen, remember, when you're trading an option, or excuse me, when you're looking at the stock or you own the stock, it's going to adjust the price the next day, right? Your shares of stock, it's going to adjust that price. Well, the options premium, again, apart from what I just described about the volatility, the actual price of the stock is still going to connect its value to the price of the option. So as it adjusts, your option will adjust, right? Your option will adjust. That's not really the concern so much for the option trader in that environment. What I described about the volatility, for me as a buyer, I'm buying a call option. I'm buying a put option, what we would call going long, whether I'm buying a call or a put. That's a long call. That's a long put. I'm buying. That's what makes it long, right? I expect it to go directionally up or directionally down. That's going to be a situation where I'm going to run into what we call volatility crush, right? What's the crush? The air coming out of the balloon post-volatility event. You're like, oh man, I think Amazon's going to zoom straight up as a result of this. Let's say you're right about that. You may have so overpaid for that call option because of what? Because of the volatility. The market makers aren't dumb. They're going to pass on your potential to make big profit in a very volatile environment. They're going to pass it on to you in the premium. You got to pay to play. And if they pass on a lot of that cost, and then the next day they pull it out of the cost of the option, which they can and do, right? They can do and they will do. Then you find, oh my goodness, this thing's moving in my direction and I'm not even doing what I thought. Now, you might be profitable, but you might not be as profitable as you thought you would be, assuming you got the direction right anyway, right? So we don't buy based on just events like this for short-term trades. And I'm glad you asked that, because that's a really important point for me to make in closing. We don't go out and just buy stock splits short-term just because. We have a whole system here at Tradeway, and I like to call it not the basics, but the foundation. That's step one. Start your journey right there on the Tradeway main page, tradeway.com. You can join in there. If you're already one of our students, you can always reach out to me, support@Tradeway. Let me know, hey, Blair, you mentioned that stock splits course. I'm interested in getting into that, right? That's something that you will want to do, right? You'll want to do that because there's some implications here if I'm going to go out and I'm going to start trading these kinds of events, right? I would say this we even have courses that help us trade earnings. Blair, didn't you say we never trade earnings? Well, there are certain things around earnings we never do. We get out for a trade, not a long-term buying and holding. We get out when it has an earnings report. Remember, every publicly traded company is going to report 4 times a year, quarterly earnings report, because it comes out quarterly. Okay. So we would get out. But even then, we've got some strategies that we can teach you so you can do it safely. Point being, I have a foundation of why I do what I do. I'm not going to go out and just buy Amazon and Google for a short-term trade just because it's splitting. Remember what I said today. If you're considering a long-term relationship with a corporate entity because you expect appreciation, I've given you some things today to think through. Hopefully you understand splits all the more. And just know that those options are going to be adjusted along with the split itself. Appreciate you guys so much for being on here. This was a little bit more of a heady episode, but I hope you got a lot out of this. Remember, you can always send your questions to me. Market Monday, support@tradeway.com. Support@tradeway.com. They always send those over to me so that I can get back to you. If you have if you have a question or an idea for something you'd even like to see on a Market Monday episode, you can send that in to us. I definitely take those into consideration heavily. So I want to help you get where you want to go. Remember that the role of the trader is to manage risk with the goal to make a profit. That's what I want to help you do. Thank you guys for being on tonight. I appreciate you so much. Thank you for being part of this community. If you know somebody who needs to hear this message tonight, would be interested, go ahead, tag their name on Facebook, send this over to them, the link on YouTube, get them in here, get them involved. If you haven't subscribed or liked, click the like button, click the subscribe button. We're not going to bombard you. We're just going to let you know anytime we're going live. We've got lots of great content all week long. So make sure you sign up for that and we will let you know. You won't miss anything. I appreciate you guys. Have yourselves a good night.